Hello and welcome to this module where we are going to discuss stock transactions and stock movement analysis. A stock transaction refers to one of two things. Firstly, there is a physical movement of stock. In other words, stock has been moved from one place to the other. It could be stock that came from a supplier into our stores, or it could be stock that came from the stores into the factory, or stock from the stores to a customer. So there is a physical movement of stock that represents a stock transaction. A stock transaction can also happen even when there has been no physical movement. This happens when there is a change in the logical position of stock. So we refer to it as a logical movement. Take, for example, an item that is expired and we change its status from goods for sale to a scrapped item. That item may not have necessarily changed location, but could be kept in stores as evidence. Logically, it has moved from the goods for sale account into the scrap account. So it is not all stock transactions that result in a physical movement of stock. So we are going to be looking at different stock transactions that are involved in a typical life cycle of a stock item. You need to understand that each and every stock movement is a double entry transaction. It means we must always specify where the stock is coming from and where the stock is going to. In other words, we need to say which is the store which is issuing this item and from which stock account is it coming. Then we also specify which is the store that is receiving this item and into which stock account. Depending on the transaction, you might have one store involved both on the from side and on the to side. You might also have a transaction that involves two different stores, one that is issuing and another one that is receiving. So we are going to quickly run through the different type of transactions and see what effect they have on our stock. When we place a purchase order, we add the order quantity into a stock account that we call on order account. So the balance for that item is now increased by the purchase order quantity. So if that item was not on order before, it means that its balance was 0 in the on order account. But if we now place a purchase order for 10 items, we now increase the balance for that item in the on order account to 10. So that account is not holding physical stock. It's only a number that represents how many items have been ordered. So it's a logical account, not a physical account. When the supplier now delivers the items that we have purchased, the purchase receipt transaction receives physical stock from the supplier into the goods inwards or goods receiving account. So physically, that stock, we can say it is now in our stores, but we put it in a logical account that we call the goods receiving or the goods inwards, so that it describes that this item is still coming inside the stores. It's not yet booked into our main account, because when it is in the goods receiving account, it will be inspected, and then any items that were wrongly supplied or any items that were damaged must be sent back to the supplier. So whatever we receive on the purchase receipt, it now reduces the balance in the order account, because that item is now no longer on order, but it has now been received. Then the third transaction is the supplier returns. This transaction returns to the supplier physical stock that was wrongly supplied or that was damaged on receipt. It reduces the goods inwards account and increases back the on order balance by the quantity of the goods that were returned. So if we now send back to the supplier, our back order must increase, because now we still expect that quantity from the supplier once again. All the items that were correctly supplied in good condition are now moved from the goods receiving account into the main stock account. It could be a free goods account, it could be a goods for sale account, you might call it goods on hand or stock on hand. It depends on how you have set up your stock accounts. But now we are moving the stock from the goods receiving into the main holding account for stock in our stores. When we do a stock transfer, we are now moving physical stock from one store or warehouse to another. It reduces the balance of the issuing store and increases the balance of the receiving store, but the overall company balance remains unchanged, because the stock is just being moved around within the company. So the total stock balance for the whole company remains the same. When we now issue or we sell our stock, we move physical stock from the issuing or the selling store or warehouse to a customer or a consumer within the company or the production facility. This transaction reduces the balance of the issuing store and also reduces the overall company balance, because the item is now out of our store system. So any transaction that takes the item from the store system reduces both the balance of the issuing store as well as the overall company balance. When we write off or scrap stock, this transaction moves stock from its current stock account into the scrap account. It means that stock can be written off at different stages. Firstly, you can write it off right at the goods receiving. You receive the goods in good condition, then somebody breaks the item there. You can write it off and scrap it from goods inwards straight into the scrap account. An item could be in the free goods account or in the goods for sale account. Something happens to it and it needs to be scrapped. So the scrap account can receive goods from different accounts within the system. Then we have a transaction which is the store's returns. It takes care of items that are being brought back to stores, either by your customers or by your staff members who came and received items. Probably they got the wrong item, or they discovered that the item is not in good condition. So we need to book it back into stores to indicate that that item has been received. So that transaction, it increases the balance of that item at the store which is receiving, and it also increases the overall company balance. Next, we have got a stock adjustment transaction. So the adjustment does not involve physical movement of stock, but it is just an adjustment of the stock balance on the books or the database. An adjustment can be positive or it can be negative. And there are two main reasons why we need to make an adjustment. Firstly, after you have done stock take, there might be a difference between the physical balance and your records, and you come to a conclusion that there is need to adjust the record. So you go into your computer or into your books and you change the record so that it matches the physical balance. You can also post a stock adjustment if there was an error in posting a transaction. So in other words, you have recorded the wrong quantity. So you now come and you post an adjustment transaction. So remember, when we say we are adjusting, you are not bringing an eraser and you rub the balance 50 and replace it with 20. No, you never do that. You start from the balance of 50, you post a transaction that says this is an adjustment transaction. I am adding 5 to the 50 so that it becomes 55. Or I'm making an adjustment, I am subtracting 5 from the 50 so that the balance becomes 45. There has to be a clear audit trail as to how the balance came to be what it is today. The different number of stock transactions that your system can handle will ultimately depend on the level of detail that you want and how much attention you want to pay to every change in the status of stock. So the use of stock accounts comes in very handy where you want to monitor every single movement and every single change in the status of your stock. There are some people who want their life very easy. All they want to know is whether the item is in stock or is not in the stores. They don't care about the logical disposition about these stock accounts. All they want to know is whether that item is there or not. So that is a dangerous way to live, because one day you are going to think you have valuable stock and yet you are just counting stock that is obsolete, stock that has been scrapped, stock that is damaged. So you need all these different stock accounts so that you can know the status of all the item codes that are on your records. One of the most important things when you manage stock is the ability to analyze your stock movements. So stock movement analysis, it helps you to make decisions on how to handle stock in the future, on how to order stock in the future. Stock movement analysis helps with decisions on which items do we need to discontinue, which items should we order more, and so forth. The first kind of report you can generate is called an item stock transaction history. This is an audit report for a single item that shows all the transactions between two specified dates. For each transaction, it shows the balance before the transaction type and quantity, as well as the balance after the transaction. This report is useful in explaining how stock came to the current level from a particular date, and also helps to show transactions that were not recorded but the stock was issued or received. So a typical example of a stock transaction history would have transactions, say from the 1st of January 2020. The item starts with a balance of 0. Then the first transaction is a purchase of 20. So that transaction will now say from 0 we bought 20 and ended up with 20. The next line, it shows another transaction which is probably an issue or a sales transaction, where you start with the 20 and you sell 5 and you end with 15. So it goes on and on and on, showing you exactly how the balance of the item was changing. There are certain times when you'll find there is a gap because you did not record certain transactions. It might happen that you receive goods from the supplier, but you do not record those goods. They are physically in stock. So a person can come and ask for them, and you can issue them and record the issue. But now there's going to be a problem with the balance in the system, because that balance did not take account of the stock that was received. It is simply subtracting stock that is non-existent in the system. That is how you end up with negative balances on your system. The next report is a stock movement summary. So this type of report will show summary movements for all the items, and it shows one line per item. So for a particular period, you can choose whether it's for the month or for the quarter or for the whole year. It will take item number A and says the opening balance was 100, the total receipts were 200, total issues were 100. If there were any adjustments, it also puts the adjustments. Then it tells you the closing balance was 200. So in other words, it's showing you what is the net movement from the beginning of the period to the end of the period. When you now take this single summary line for the month and you add the line for the same item for February, for March, for April, you now get the next report, which is a trend analysis report, because it is showing summaries for each month, one after the other. So for that item A, for January, you have opening balance, receipts, issues, closing balance. For February, you have opening balance, receipts, issues, closing balance. So you see the whole trend from January to December. When you look at the closing balance, you can see whether you are maintaining the same average kind of balance or whether you're actually accumulating stock. Because for those people who buy more than they need, they always have excess. So if your closing balance for January was 20 items, in February your closing balance will be 30 or 40 or 50. So it will be increasing every month, because with every purchase you are buying more than what is being utilized. So a good stock manager ensures that what they buy is consumed. So your closing balance for the month ought to be almost the same, not exactly the same number, but within the same region, showing that you are purchasing only what you need to consume. What we're going to do now is we are going to go back to my system. I'm going to post a number of transactions, after which we will then explore the different types of reports at the individual stores, as well as the overall reports for the company. We'll also look at the stock movement analysis reports that are available. So I hope you'll be able to follow on your own copy of the software as we go through the transactions. So we see you in the next module.